If you're anything like the other 99% of traders who try to trade order blocks, then your trades probably look something like this. You mark up your order block, your perfect order block. You placed your trade, you get tagged into your trade, and everything seems to look good. And then out of nowhere, for no reason known to you, price just obliterates through your level and you're left with another stop loss, wondering and doubting whether what you're doing is correct and why your order block didn't work. Well, in today's video, I want to reveal to you how to actually choose the correct order blocks that work consistently. This is a 4-part video. In part number 1, I'm going to define to you what an order block actually is and why they work. In part 2, I'll show you how to actually identify an order block, or the 3 different types of order blocks that exist. In part 3, I'll share with you my 3 golden rules to make sure that you're choosing the right order blocks. And take this from someone who has years and years of data. This is something that I have tested in depth over hundreds and hundreds of trades. And then finally, in step 4, I'll put everything together into a step-by-step trading strategy so that you can take order blocks and put them into a profitable trading system. Let's dive straight in. So what actually is an order block? An order block refers to an area of price that is protected with more orders. So take this area, for example. This is an area that is likely filled with more orders, so that when price comes back into this level, it will just bounce off. It essentially acts like a blockade, and it's very difficult to trade through this level, simply because it's armed with more money. There is more money sitting at this level that wasn't filled originally. Imagine for a second, I wanted to place 100 lots on Euro USD. But at this current price, because I have so much volume, I can only pull off 50 lots right now. What I will do is I will place my 50 lots, maybe price will go up, and then I will put another 50 lots at this level for when price comes back, so that I can get my other 50 at this price, instead of getting 50 at this price and then price goes up, and then I have to put another 50 in here and price goes up even further. That is how smart money operate. That is how institutions position their orders. When an order block gets printed and it follows the rules of smart money, the rules that I'm going to be outlining to you in this video, then when it gets at this level, it is likely going to bounce off in the continual direction that it was trading. But not all order blocks are the same. The truth is, order blocks are everywhere, always, and 98% of them don't work. If you choose the wrong one, hoping that it will block orders, it's just as delusional as a fighter jet shooting a rocket and you trying to protect it with a cycling helmet. It's going to destroy you. And that's what happens to 98% of order blocks. 98% of order blocks just get traded straight through. And that's why you're struggling right now with trying to trade them. So let's dive in. A good order block, like the one that we see on screen right now, should hold this level and simply produce a bounce reaction. And the entire goal with order blocks is an area of price that you can look to be a buyer or seller from. They are not the be all and end all. You still need other factors. So how do we actually spot them? Well, here are the 3 different variations that you could use when identifying order block. And the truth is that no one or the other is more or less valuable, as you will see as we get later into the video. So the first definitive type is the final sell candle before an aggressive buy move toward the upside. And notice, typically speaking, all good order blocks should leave an area of market inefficiency. Market inefficiency from a price action perspective can be witnessed as taking the first candle in a 3-candle formation, the first candle high in a bullish example, and the third candle low. And you will see that this low does not touch this high and it creates a gap in the market. That is what we obviously call a fair value gap, which is essentially just an area of market inefficiency. This shows us that aggressive buyers dominated at this level. The same can be true for a bearish example. If you were to get the flip side and you had a bullish candle followed by a very aggressive bearish candle, that could too be your supply zone. So the first one is simply the final sell to buy in this bullish expansion. The second variation is, again, using that sell to buy, but in a multi-candle formation. Sometimes you might get an aggressive sell candle and then a few bullish candles and then a big bullish candle. And you can still use just the bearish candle itself as the order block. So you can see in here that we have used from this high to this low as the order block, not really caring about this candle. And the third example is using the first candle of the momentum. Simply put, when you have this bullish momentum and it leaves this fair value gap, we are interested in the first candle to really build that momentum in that price leg. So not one is better than the other. All are completely valid order blocks. It just depends on the situation because each price scenario may give a different type of order block, but you can use all of them. There will be no differentiation. So remember the two examples that we just looked at. And if we look at this specific price action right here, you can see that before this aggressive move toward the upside in here, there is a big sell candle right here. This is a sell candle before an aggressive buy candle and a continuation. You can see that the final candle, the high of the first candle, the low of the third candle, they do not touch. So we have a fair value gap. In this scenario, you could use option number 1, which is the final sell to buy, as the order block. You could also refine this level and you could use this level and you're focused on this one, right? They are both completely valid. And in this instance, I personally would use the final sell to buy. An order block is just an area of interest. There is something far more important that you need to see before even thinking about taking a trade. And I'm going to share that with you in rule number 3 of my 3 rule principles. Additionally, if you look here as well, what you can see is you can see a bullish candle before aggressive sell-off. This bullish candle before the sell-off right here, that would be the example of a final buy to sell. So again, no specific order block is better than the other. I have the data to prove it. But all of these 3 types of order blocks do exist and they all do occur, but they all occur usually differently. And so depending on the situation, use the required order block. So now we know what an order block is. We know how to identify them. Now I need to walk you through my 3 crucial rules that will separate the losing order blocks to the winning order blocks. The first principle and the first rule is follow the money. What does that mean? I see so many people trying to trade order blocks and they don't follow the money. They do literally the opposite. And so for me, follow the money is only trading from order blocks that are pro trend. It sounds very simple, but you would be shockingly surprised at how many people ignore this principle. For example, here you can see we have a swing low, we have a swing high, we have a break of structure, so we are bullish. We have a higher low, higher high, price comes down, higher low down here, right? Again, what is this? This right here is a bearish order block. But notice that we are bullish. You would be so surprised at how many times I see people trying to trade from order blocks like this because it gives a little displacement inside of this price leg in here, or it gives a perfect fair value gap, right? And they try to trade from this level and it has a reaction and then it just poof straight through their level and they don't understand why. Do not try to trade against the trend. Again, swing high, price comes down. We have a break of structure, right? Swing high, swing low. We're pro trend. Where is our structure? We have a swing high up here and we have a swing low down here. We've just created a bearish order block at this high, which is really just not important to us. What's important to us is order blocks that are with the trend. It's that simple. So most people, again, can get confused with this. Make sure you're using external structure, right? Swing high, swing low, swing high. What I see so many people do is they go, okay, this is a high, this is a low, high, lower low. Okay, now we're bullish. Come in here. Okay, now we're bullish. Okay, so now there's going to be some order block at this level and I'm just going to trade that level. And then when we trade through it, we shift bearish and now I'm going to trade this level in here. And they try to trade from here, but we're still bullish, right? Like, please, please, please remember, we are bullish. And so the level that we should be trading from and the only level we should be trading from is this one. This sell to buy here at the low of this price leg, right? Follow the money. The likelihood is, the probability tells us that price will come down here and will block orders and bounce and continue. And this is where we want to be looking at trading from. Always, always, always follow the money. So here's an example of what following the money actually looks like. So you can see here, we are pretty much in an established bearish market. Of course, price has become a little bit choppy, but you can quite clearly see that we are bearish, right? We have a break of structure down here. We have another break of structure down here. So you can see here, we have, maybe swing low, swing high, swing low, swing high, swing low. Price comes back up to this level, swing high, swing low. So you can see that we are bearish, right? Now what happens? Again, aggressive continuation in that direction. A wick of this high, which doesn't count as a break. So we have swing high and we have what we think may be a swing low. So follow the money, right? What else can you just see? Well, you can see that price just left behind also a bullish order block. And you know how many people are just looking into the wrong types of structure? Like they look at this low, this high, this low. Okay, that's some type of shift. Okay, fair value gap. Okay, I'm going to trade this order block in here, right? They're going to try to trade from that level. Okay, cool. Wrong. You might get that reaction, things start going well, and then poof, you're just going to get traded straight through. Why? Because you weren't following the money, right? You should have been following the money. If you were following the money, you would have noticed that we had a swing high. We have an obvious bearish order block, and then we have a pullback. We tap perfectly into this order block, and then we take these equal lows straight into this direction. You want to be the person who's patient enough to wait for this level, not impatient enough to try to trade this or this. Because again, it might have a little bit of a reaction, but eventually it's just going to fall through. It's going to fail. So principle number 2, avoid the traps. Now, to me, this just sounds obvious, but again, I am so surprised at how many times I have people come to me and they're like, why doesn't my order blocks work? And they are sitting at levels that are so obviously traps that anybody should be able to see it. And so first and foremost, what is a trap? A trap for me is an area of liquidity that you're expecting price to trade into. So for example, that could be equal highs. That could be trend line liquidity, right? That could be equal lows, right? What else could it be? It could also be Asia session high. It could be Asia session low, right? It could also be previous day's high. It could also be an area at previous day's low, right? Areas that you would expect that price is going to want to run into to collect liquidity. And so make sure that we're avoiding the traps. For example, you can see here, structure, follow the money. So you can see here, we are bullish, right? We have a swing low, higher high, higher low, higher high, higher low, higher high. So we're bullish. And that's awesome. A lot of people are able to follow step number 1, but then they're not able to avoid traps. Here we are, we can see we broke structure from this level, which is completely fine. There's a beautiful order block here, amazing. But what you're not looking at is below here, we have, for example, Asia session low, or maybe we have London low, right? We also have equal lows, right? We have liquidity at these lows, and we're expecting that price is going to want to come through this before going. And so make sure that you're avoiding the traps. Make sure that you're following the money and make sure that you're avoiding the traps. So in this scenario, we want to be using this level, right? This level here is the level that we want to use, not this level. This level, a lot of the times, is going to get traded straight through. And what will likely happen is price will hit this level, have a little bit of a reaction, just come straight through here until it gets to the real level, and then it goes. And you're left thinking that you were just early, but you weren't. You didn't avoid a trap. You got trapped. This is a beautiful example of what avoiding a trap can look like in your trading and how you can actually get trapped in this type of price action. So this is from a day that I actually traded myself live with my inner circle members. We traded this and traded it live. We were buyers of the same price action. So we're all correct. The bias is long. And if you think that it would be a good fit for you or beneficial to you to be one of those people that I live trade with every single day, you first have to be a verified member of Prosperity School. So if you want to go down that route, I'm leaving a 45-minute training down below that I think will massively help your trading. It's first, but secondly is the route into our ecosystem. Check that out. It's the first link in the description. But yeah, this was a trade that I caught and I can put it in here. And what I specifically said was essentially, we're going to wait for this level to get taken. So you can see here, right? No doubt about it. We are bullish and that's awesome. And we also have some kind of internal realignment, right? So you got this internal structure shift in here, right? Coming into London session. The problem is though, is you have this order block down here, which is perfect in theory. And on the hourly time frame, maybe it's this one. The problem though, is that this right here is Asia session low. This right here is previous day's New York session low, right? So they are obvious points of liquidity that we're expecting price target. So I specifically say in my morning outlook, I am a buyer as long as we trade below this level. And I'll literally put that clip in there. I'm looking at a liquidation of this Asia low and then lower time frame shift. and then trade longs. And so I'm waiting for price to, yes, trade higher, but I want it to be below this level because this is a trap. It's a clear and obvious trap. And what happens later that day? We trade straight through it. And then New York comes, we go for one more sweep of that low. And at that point, I was already a buyer. I had already brought in these lows. And actually, you know what? I will explain this trade. This is the trade that I'm going to walk you through using this specific model at the end of this video. And then you can see, right? The next day, price rallies. And this was our end target. So make sure that you avoid traps, right? Avoid these traps because trust me, order blocks at these levels, they just don't work. They just don't work. Okay, and finally, before putting this all together into a step-by-step trading strategy, I want to show you my rule number 3, which is how to put order blocks on steroids. You see, what I've taught you today is good enough for you to go away, use those 2 principles for order blocks, and you will remove most of your losing trades. Quite literally, if you just follow the money and avoid the traps, you will make good money trading order blocks. But if you want to put order blocks on steroids, if you want to increase your win rate, how many trades that you win, how many order blocks that you're right on, and you want to increase how much you make when you're right, then this is literally one of the most powerful tools known inside of my strategy arsenal. And without this, I wouldn't be anywhere near as profitable as I am. And that is order blocks on steroids, which is the right confirmation. You see, it's all well and good having an order block. You can see here, we have a swing low, we have a swing high, we have a swing low down here, we have a higher high, we hit above these highs in here, and we have an order block. But maybe that order block is all the way down here. Or what sometimes happens as well, guys, is that maybe price starts trading higher like this, maybe you've experienced this, and then out of nowhere, you get a pullback and a continuation. And maybe you have 2 order blocks. And in these scenarios, you don't quite know what to do. Option A, do you just choose one and forget the other? Do you just do what I tried to do when I first started trading? And I was only confident with taking the origin levels because I was scared that these ones wouldn't work. That bit me in the ass. There's so many trades that are just short continuations. So do you A, just avoid this one? And then you, how many times have to just watch this as you could have just continuously over and over again taken the trades from this level? Do you avoid this one? And then you take your loss in here and then you watch the same thing again as price reacts from this level? Do you trade both of them and double your risk exposure? Do you take this one and then also take this one? And so on a losing day where you are wrong, which is going to happen, you took a loss on this one and a loss on this one. What do you do? For me, the answer to this question was simply order flow confirmation. So when I have my directional bias, right, I'm following the money. What happens is when price is coming back on the 1 minute time frame, price is going to be bearish. So when we get into these levels, I'm waiting for a pullback into here and a shift above this high. So you'll notice here, right, that we are 1 minute time frame is bearish. I'm waiting for this to get shifted above the highs. That's my confirmation that this is the order block that I'm going to use. And then what I do, which is sneaky, but it's so crazy. Imagine, for example, you were just trying to trade from this order block. You put your stop loss below this low and you're just targeting a 1 to 2, right? Imagine that for a second. That's what a lot of people do. For me, with my confirmation, here's what I can do. I can wait for this. And so I get extra confirmation, which means that I'm right more than I'm not. And then I can just use the order block from this level. And so I can just be a buyer from here and I can put my stop loss at this low. And then all of a sudden your 1 to 2 risk to reward for me is a 1 to 9 risk to reward. I'm 4.5 times more on my return on investment. And you know what that means? That means that if you take 10 trades, right? If you take 10 trades and you lose 5 of your trades, you lose 5. And if you win 5 of your trades, you gain 10. So 10 minus 5 is 5. So you got 5 times your risk. If I take 10 trades and I win 5, so I win 9 times 5, 45, and then I lose 5, so minus 5, I'm 40 on my risk reward. I'm 8 times more profitable than you, simply because I understand how to use risk versus reward. That is my secret weapon. And what can happen to you as well is you might use this order block here, 1 to 2 risk reward, and you've taken that trade, right? But for me, I didn't get confirmation because at this level, if I don't see this shift happen, I'm not a buyer. And you would be surprised at how many times price comes into an order block and just trades straight through it. And you've taken a loss right now. But for me, I'm just waiting to see this. And then I take this. And now all of a sudden, you're a buyer at this level. Congratulations, it's not a terrible trade, right? You target the swing high, 1 to 3.5. It's not a terrible trade, but you've just lost 1, so you're actually 2.5. But me, I've waited for my confirmation. I've executed down here. My stops are at these lows, and you're 1 to 3.5. For me, it's a 1 to 10.5, and I haven't already taken a losing trade. All because I wait at my order blocks, I wait for a shift of order flow. And that is simply bearish structure on the 1 minute time frame, flipped to bullish structure on the 1 minute time frame. And then I just trade the 1 minute time frame. And I use the 15 minute and the 1 minute as fractals together. That is how you literally put order blocks on steroids. So now what I'm going to do, I'm going to tie all of that together with an incredibly beautiful trade that was executed live with my inner circle students. Hats off to them. My students on this trade made collectively, I think, over $100,000 on just this one trade. So this is that strategy that I'm showing you right now. Now, step number 1, follow the money. Very, very simple. So if you're following the money, you will see that we have a high here, and then we come back, and then we have a new high, and then we come back, and then we have a new high, right? And now we're between this high and this low. Me following the money is looking at buys, plain and simple. I want to look at buying. I need to buy inside this range. Now, different types of order blocks. You can see that we have option number 1, which is right here, which is on the edge of Asia. So many people getting stuck as London opens trying to be a buyer from this level of continuation. Step number 2, avoid the traps, right? Clear and obvious liquidity at this level. Avoid the traps. So you want to try to find order blocks that actually make a lot more sense. For example, like this, sell to buy down here, right? Sell to buy. That can be our order block. It's that simple, right? Step 1, follow the money. We're bullish. Step 2, avoid the traps. Don't try to choose order blocks that are sitting on liquidity. And then step 3, confirmation. When you get into this level, simply wait for the right confirmation. When we get into this level, again, if I just zoom out, it's the same thing, right? You can still see it on the 1 minute time frame. That's the swing high. That's the swing low. That's the new swing high. That's the order block 1. That's the order block 2. That's a trap, right? When price gets into this level, you go to the 1 minute time frame and notice something. Your higher time frame is bullish. That's what I'm expecting. But on my lower time frame, look how bearish I am, right? I'm very, very bearish. So what do? I wait for price to shift from being bearish, and I wait for price to shift to being bullish. Like, it's not rocket science. Trading actually isn't that hard. And so notice, right, you can see that we shift the highs in here. So we become bullish, but again, it's not my session open yet, right? Again, highs above here, we become bullish. Now we become bearish. So at that point, we're bearish, right? We're bearish, we're putting in what structure? We're putting in bearish structure, right? We're obviously bearish. So we're still bearish. So at this point, if this high goes, that's my confirmation. What happens? We shift bearish again, right? We go low, high, low. Now, if we shift this high, I'm a buyer. What happens? We shift that high, right? Plain and simple, we shift that high. And I usually use the 5 minute time frame, but on this instance, there's not really an order block in here. It actually looks quite messy. So you can use a 3 minute time frame or whatever minute time frame. And you can see here, same thing applies in the lower time frame. This sell to buy, you can encompass them both. Long position, entry there, stop loss goes below this low, right? Now what you can do, and then honestly, I'm not going to sit here and tell you that I held this entire trade all the way up to here. I didn't, right? 17 risk reward, I didn't do that. I cut some off at 5R, some off at 7R, and then some off at the full take profit. But if you were just the type of trader who was just trying to trade only this order block, pro trend, again, not a terrible trade, right? Genuinely not a terrible trade. Like you're following the money, you're on point. It's still going to be a 1 to 4 risk reward. But the difference between you and me is now you have to wait. If you get tagged, you have to wait for price to go all the way to here before you can make money. Because I'm aggressive down here. I don't have to do that. I'm taking my first piece of money when we hit 5R. When I hit 1 to 5 risk to reward, I'm taking off money from the table. So all price has to do for me is this, and I've made money. And then it can come down here, I've still made money. There's a lot of times where your little reaction from your order block, right? You're in profit, and then just boom, down. When you don't use this confirmation model, for me at this point, if price does this and then goes, you took a break even, or maybe you took a loss. I've already closed most of my trade. I closed half here, I closed another half here. I have a final 25% to run to this high. So excellent trade management, which is a bonus for you. So this is the overall trade. That's the overall target. And again, please, this is taken live with my students in the moment. We executed this together. And that's the trade idea. And you can see price comes straight in and absolutely rockets straight out. Literally within, we place the order 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Within 10 minutes, I have hit a 1 to 5 risk reward. On $500,000 account, risking 1%, right? So you're risking $5,000 on that one trade and you just 5 times that. And then you closed half, $12,500 in 10 minutes. And the trade isn't even over yet. And it's crazy. So many of my students and my clients have $500,000 in funding. Like, it's not a difficult thing to do. It sounds difficult, but it's really not. And then before you know it, my next take profit, which was these highs, that gets hit as well. How long is that? You're tagged in 5, 10, 15, 20, 25, 30, 35, 40. Less than 90 minutes. Boom, 1 to 10. And then for the rest of the take profit, well, it took overnight. So whilst you may be trading just this order block, maybe, if you're following the money and avoiding traps, that is, at the very least, you've still made money, but you've had to hold through this. You had to open it, hold it overnight, take the swap fees. You're still in the trade. Price is coming back down. You're psychologically exhausted, right? You're thinking about closing it. And then boom, okay, now you've hit your take profit, 1 to 3.8. So what took you almost a whole day literally took me 10 minutes because I follow the money, I avoid traps, and I make sure that my order blocks are on steroids. And again, if you want my step-by-step trading strategies with years worth of backtesting and everything you need to become profitable, don't forget to check that free training in the description.